Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast, presented as always by Tusk Media. Real quick, do us a favor, check us out on Twitter, Facebook, YouTube, wherever you consume information. Twitter.com/TuskMedia LLC, Facebook.com/Tusk Media LLC, YouTube.com/Tusk Media LLC. We got a verified channel, big time like that. Able to put our own little URL in there. So check it out, hit subscribe, all that good stuff. If you're listening to the audio, we appreciate you being here. Leave us a 5-star review on iTunes, helps us out a lot. Leave us a review of any kind, actually. A bad review is better than no review on iTunes, apparently. I'm Andrew Hall, joining me today, Benjamin Nye. Ben, how are you?
I'm doing well.
Good. We're back. We kind of do this every quarter, it seems like, when we're kind of kicking off earnings season. We start off looking at earnings on a number of financial institutions that have already reported. So we're going to be looking at this week at JPMorgan, Citi, and Wells Fargo. In this particular video, we're looking at JPMorgan, but check out all our stuff. Got lots coming your way this week. So jumping in, Ben, kind of high-level view, what stood out for JPM this quarter?
Well, they had a great beat on the bottom line. Their EPS result was quite solid. A lot of that was due to a one-time legal settlement.
Yeah.
You strip that out, and they still beat 171 by my estimate versus the Street had 158, and that's excluding the $406 million after-tax legal settlement. So a good quarter on the bottom line for JPMorgan. Top line was a little bit, it had some moving parts. So you had a strong international business, and that was kind of a theme as we talk about the banks in general. Strong international currency strengthening of the euro helped with that. Weakening of the dollar in general helped. Strong non-interest income. They did relatively well on fees. Got a little leverage there, and but it was offset by slower than expected loan growth and a weaker than expected net interest margin. The analysts were very disparate in their views of where net interest margin would fall. So for some people like Goldman, it was right in line. The consensus was 2.36% though, and JPMorgan came in at 2.31. So a little softness in the net interest margin, but that's tough to really do if you're JPMorgan. You don't really have that much control there. And what was interesting as you look through the quarters of the various banks, both JPMorgan and Citigroup had a tougher time on the deposit rate, because when the Fed's raising rates, that's good for you in general, but the problem is you also have to pay higher interest on your deposits. JPMorgan got hurt a little bit on that, same with Citigroup. Wells Fargo was more insulated. But then you also had the slower loan growth. JPMorgan also reduced its guidance for the full year on loan growth, saying it's going to be about 8% now, which is still solid growth, and they said it was only modestly weaker than previously expected, but a little bit of a softening around the edges relative to where we were at the beginning of the year.
Yeah, and it's a little bit of a narrative shift, it seems like, in some regards, relative to what we've heard for the last couple of quarters or even the last couple of years, where all we were really waiting on was really for net interest margins to kind of drive these businesses. We were really expecting that to really kind of push things through. What's the interest rate environment going to be like? Are we going to get a hike? Are we not going to get a hike? And now that we've kind of seen what's come to fruition from the Fed so far this year to date, we've seen things that certainly lend themselves to be positive for financial stocks. And yet, financial sector is actually lagging the market a little bit. And then you have something, and all of a sudden the story shifts a little bit to one of the bigger things I thought was just the slowing down loan growth.
Yeah.
And so all of a sudden you kind of see the reverse of that. Well, when interest rates go up, that does have an impact on people other than just banks.
Yeah. And what happens with the banks too is you have that spread. So you borrow short the deposits and lend long. So if you have a wide gap between your 2-year bond and your 10-year, then that's going to be good for the banks. But if that curve flattens, if the gap between what you get paid on 10-year and 2-year starts to flatten and get smaller, that's a pressure on banks, because they still have to borrow essentially, and then they lend that out. And if that yield they're getting on the lent dollars is lower, that's not going to be good. A lot of people are talking about the Fed controlling rates, but they control the short end.
Right.
They don't have as much control on the long end. Now that could change when they start selling off assets, but so far it hasn't really resulted in a steepening of the yield curve.
And that's really one of the things I think, just from a macro perspective, people aren't talking enough about, is really what the long part of that curve is doing in terms of just basically staying flat. You see that has an impact almost everywhere in terms of looking at investments. Even looking at fixed income, things like that. That obviously comes into play, and again here kind of creates a little bit of squeeze.
Yeah, and it gets to the idea that financial stocks are almost quite a good investment if you do think that the Fed will lose control of the long end of the curve.
Right.
Because if that long end starts to just float up and up and up and up, and we get into this inflationary scenario, banks will do well. The problem in the second quarter is that the reflation trade of the first quarter kind of faded away, and you had commodities falling down. You had CPI prints coming back down to earth a little bit more, and relative lack of wage growth. I mean, I still think that 3-4% wage growth is symptomatic of a strong economy, but it's not the blockbuster wage growth driving inflation that banks like to see and what you want to see if you want that curve to steepen.
So, we hit on net interest margins a little bit lower than expected. Just really kind of depends on what everybody else was looking. What were some of the positives for JPMorgan?
So the international business, as we touched on, was strong. Not only did they get the boost from the currencies, but they also got the boost from just strengthening in the economy. I mean, you see that everyone's talking about the Europe doing a lot better now. That Draghi said that he came out and said whatever it takes, and now they're talking about actually hiking rates. And until really 3-6 months ago, the thought was rates were going to be low essentially forever in Europe, and maybe negative. Yeah, I mean, you had a negative German Bund yield just this year, and now that's up to 50 basis points. So, still 50 basis points on a 10-year paper. I don't know if that's attractive, but on a relative basis to where we were, that's a lot of improvement, so that's really good for those European results. And JPMorgan does have a sizable European business, and we did see that translate. If Citigroup is the most global of these three, JPMorgan's kind of split between international and U.S., and Wells Fargo is almost entirely U.S. You do see that translate into how good the quarters were. I think it's interesting to look at Citi, which had arguably the best quarter of the three. JPMorgan is kind of in the middle, and Wells Fargo down at the bottom end. So that's interesting to watch too.
So looking ahead, looking forward, we own JPMorgan stock, full disclosure. You continuing to hold on to it? You got any idea on where this company's heading and what you're paying attention to really in the next quarter? I'm
continuing to hold on to it. It's at the top end of my valuation range. I do think that Citigroup is cheaper, and I think Wells Fargo has a little more. It could have a little more juice. It has a little more explosiveness because it's been so pressured by the account scandal. That said, JPMorgan is just extremely well run. They continue to operate with good efficiency. Their non-interest income was a bright spot in the quarter. Has that mix of the U.S. growth component, but coupled with some international exposure as well. They could do well if taxes decline. And what Jamie Dimon is most bullish about, and what he really pressed in the call, was if these guys in Washington can just get their act together and reduce regulation, then you could really see some explosiveness in these stocks. And JPMorgan is a simple way to play that. And simple is not bad. So I'm continuing to hold it.
There we go. Any other closing comments on JPM?
That's it for me.
Very good. Hit subscribe. We appreciate you being here. Also, stay tuned on YouTube. We have a kind of a macro webinar type thing coming up. We're going to take a look at the U.S. economy, some factors there, as well as a little bit more global perspective on how things are going, and also tie it all back into our portfolio here at Narwhal in terms of just what we hold more broadly speaking. We're talking our book. That's the book we know. Yeah. So check that out. We will have that in audio form, but it's probably going to be pretty awkward because you're not going to have the slides. Yeah. But check that out on YouTube. YouTube.com/TuskMedia LLC should be up later this week. Y'all have a great day. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.